Let's talk about the health status of your business. How do you check this? How do you check if your business is healthy or it is not healthy? Because as an entrepreneur or a business owner, you want to run a business that is healthy. So I'm gonna talk about some couples of targets that you can have for your business, and they can help you to check if you are running a healthy business or not. The first one is the total income. So the aim must always be to increase the total income month after month and year after year. So if your total income is increasing every month, it means that your business is doing well. For example, if this month you make 100,000 per month, so you must aim to make 110 or 120 next month. And then the following month, you must aim to make 150. So you must also compare this year on year. So if your revenue for this year was 1.2 million per annum, next year you must aim to generate about 120 or 150 million, 1.3 or 1.5 million per annum. That's number one, the total income. Number two is the net profit. You must always make sure that the net profit for your business is increasing. So the net profit is the difference between the total income and the total expenses, all the expenses. So that gives you the net profit. So you must always make sure that your net profit every month and every year is increasing. The next one is the net profit margin. So the net profit margin is basically the percentage of the profit that the business earned in relation to its revenue. Okay, so to ensure that this is healthy, you must always make sure that it's about or between 10% and 20%. Because if it's around 5%, it's considered very low. So your business is not healthy when it comes to net profit margin. So always aim to keep this at about 10%, 15%, or even 20%. 20% is considered very good, whereas the 10% is considered healthy. It's okay. You can live with it. But if it goes below to about 5%, then you must be worried as a business owner. The next one is cash. There's a say that says cash is king. Yes. So if your business does not have enough cash, it will be very difficult for you to run that particular business. So it's important that your business must always have enough cash to cover its obligation, to cover all the liabilities that you need to pay. You must be able to pay your suppliers on time. So you must be able to service all the debt that the business has. So you can only do this if your business has cash. So you must always make sure that you always have enough cash. So you can have enough cash to cover all the debts in a short term and in a long term. So always make sure that at least every month or every year your cash is going up. Even if you can keep it in an investment or you can convert it into an investment, but it must always be enough to cover the short term and the long term debt. You know, people who say, who actually look at this, they say that at least you must be able to meet your obligation for the next 12 months. Yes, next 12 months. So if you have enough assets that can carry you for the next 12 months, even a longer term, then you are good. So the next one that is very important, it's your net assets. So net assets is basically taking all the assets that the business has, and then you less the liabilities, the total liabilities, everything that the business owe, and then you less into your assets. So whatever that you get, it's your net assets. So you must always make sure that your net assets is at a positive balance. You don't want a situation where the assets that you have are less than the liabilities, because if we were to convert this back into liquidity, then it means that you are in trouble. You might face some challenges in future. So always make sure that you have enough net assets in your business. The next one, it's return on equity. Return on equity. What is return on equity? So is the ratio that normally the business use to measure the profitability, so in relation to its equity. So how management are able to use their equity into profit. So it's important that you must be able to have a positive profitability or return on equity. So to be able to determine whether it's good or not, this must be between about 15% to 20%. So you must always keep it that. So if you keep it that, then it's good. So it's very, very important that you are able to convert the profitability of your company using your equity. So the last one that I want to talk about is the asset use efficiency. What is asset use efficiency? So the asset use efficiency basically look at how quickly the business can convert the debtors into cash. Remember, if you are selling things on credit, you have to go and collect that money back into the business. So the ability of you converting the debtor's book, the debtor's balance into cash, it means that you are having a good asset use efficiency. And the fact that you are able to convert your stock or inventory into cash. Remember, the businesses that have stock, that particular stock is not there to stay. You have the stock, and then you must be able to convert that stock into cash. So for you to convert the stock into cash, you must be selling. So it's important that you do that so that the business can have what? Cash that we talk about at the bottom. So it's important that you also use the asset use efficiency ratio to measure whether your business is healthy or it's not. So if you take all this ratio and you measure them and you check, and then if all of them are in positive, it means that you got 100 out of 100 in terms of your health status. But if, for example, you've got 10 targets and then you only meet about 4 of them, then it means that your business is at a 40% health risk. So it means that things are bad. You have problem in terms of your health. The business is not healthy. So always make sure that at least if it's minimum is about 60%. But we are aiming for 90 to 100%. So it means that all the ratio that I talked about, you must always make sure that they are top notch. Always make sure that at least they are giving you good return. So the first one was the total income. The second one was the net profit. The third one was the net profit margin. The fourth one was cash. The fifth one was net assets. The sixth one was return on equity. And the seventh one was the asset use efficiency. So use all of them. They will help you for your business. So you'll be able to check if your business is healthy or it is not healthy. I hope this will assist you. Thank you.